Hello friends, welcome to the channel Just Try. Today's video will be about accounting term once again, and the accounting terms that we're going to discuss is purchase return and sales return. We have already made video on what is purchase and what is sales quite a few videos back, in which purposes, in case of purchase return or sales return, we will be making the entry with cash, and in which cases we will be making the entry with the debtors or the creditor's name. That also we will be discussing over here in this video. So for detailed information, please stay tuned with the video. Purchase return. A purchase return occurs when a buyer returns goods to the seller after purchasing them. This can happen for various reasons, such as defective or damaged goods. If the goods are not described or are faulty, the buyer may return them. Incorrect items. If the seller sent the wrong items or quantities, the buyer may return the incorrect items. Unsatisfactory quality. If the goods are of poor quality or do not meet the buyer's expectation, then they may be returned. For example, a company purchases rupees 100 worth of inventory on credit. Later, the return of rupees 20 worth of defective items. So the accounting entry would be debiting purchase return and allowances, that is rupees 20, and it will go through accounts payable, that is rupees 20. Sales return. A sales return is the opposite of purchase return. It occurs when a customer returns goods to the seller after purchasing them. This can happen due to similar reasons as purchase returns, such as defective or damaged goods. If the product is faulty and doesn't work as expected, the customer may return it. Incorrect items. If the seller sent the wrong items or quantities, the customer may return the incorrect items. And unsatisfactory quality, that is, if the product is of poor quality or doesn't meet the customer's expectation, then they may return it. For example, a customer purchases rupees 500 worth of product on credit. They later return it due to dissatisfaction. So the accounting entry in this case would be sales return and allowances of rupees 500 will be debited, and accounts receivable of rupees 500 will be credited. Now, when is cash entries made for returns? In case of purchase return, for immediate entry, when the purchase return is made in cash and the entry is made typically immediately upon the return of the goods. For example, if a customer returned rupees 100 worth of product purchased with cash, the entry would be made at the time of return, and it will be a cash entry. And sales return, immediate entry, is similarly for the sales return in cash, the entry is made immediately when the customer returns the product. For example, if a customer returns rupees 50 worth of product which is purchased with cash, the entry would be made at the time of return. So immediate entries, and when purchases are made in cash or sales are made in cash and those items are returned, then in that cases we do cash entry for returns. Now, credit entry for returns. In case of purchase return, upon the payment of reconciliation, if the original purchase is made on credit and the entry for the purchase return is made when the buyer pays the remaining balance and or at the time of next reconciliation. For example, if a customer returns rupees 50 of a rupees 200 purchase made on credit, then the entry might be made when the customer pays the remaining 150 or during the next reconciliation of accounts payable. And sales return, upon the payment or reconciliation for the sales return involving credit, the entry is typically made when the customer pays the remaining balance or at the time of the next reconciliation. For example, if a customer returns a rupees 100 product purchased on credit, the entry might be made when the customer pays the remaining balance or during the next reconciliation of the accounts receivable. So if we have to take out key points from our discussion that we have made over here, then we have both the purchase return and the sales return reduce the company's net worth. Purchase return is recorded on the income statement as an expense, and sales return is recorded as a deduction from the sales revenue. The returned goods are typically either returned to inventory or disposed of. Proper documentation such as return slips or credit memo is essential for tracking and recording these transactions. These are common business transactions that occur when the goods are exchanged between buyers and sellers. Understanding these concepts is crucial for accurate financial reporting and analysis. So thank you for being there with the video, and if you have understood the entire concept of what is purchase return and what is sales return, so please stay tuned with the channel and like, share, comment on the video, and please also subscribe the channel so that you can keep getting more videos on accounting information. Thank you.